My guest today is Bjorn Huseby. Michael is an associate at DLA Piper, a global law firm providing legal services to businesses worldwide. Thanks a lot for coming to the Holdco Builder show, Michael.
Yeah, absolutely. Happy to be here, man.
You lawyers are funny because I talked to a guy, his lawyer called him on his birthday and congratulated him. And they were talking, they end up talking for 45 minutes. And then at the end of the month, the guy received an invoice or a bill for consulting services. I found this to be pretty funny because I was discussing that you will be my guest. So my first question to you, am I going to receive an invoice as well?
I actually sent it before the podcast, so it's okay. You can pay it when we're done.
I will double check.
Yeah.
You're an excellent guest for the Holdco Builder show, as I want to make sure myself and the others won't make any costly mistakes when it comes to legal side of building a successful holding company or a fund or doing acquisitions. I was reading about you, and for some time you lived in South America and even in Europe. And maybe let's get started with you sharing your journey, starting all the way since graduating from university.
Oh, okay. All the way since then. All right, cool. Yeah, I went to UCLA and then I went to Columbia for law school. And I started out as kind of a broad-based corporate lawyer in LA at a firm called Latham and Watkins. I then learned that I have a disease where I'm going blind. And so I kind of reassessed what I was going to do with myself. At that point, I quit and moved to South America and basically was a writer for about a year, which is partially part of the reason why I like writing so much on Twitter and LinkedIn, that sort of stuff. And then so I met a girl down in South America and she lived in Belgium. So then I moved to Belgium to be with her. So I lived there for a while during COVID, which was nuts. I actually got into Belgium the day they shut the borders for COVID. So if I had been there like 6 hours later, I probably wouldn't be married to my wife right now. But I got in and we are married. We live back in the US now. Now I just do funds all the time. I followed a partner from Latham, my original firm, to DLA Piper. And so that's why I am where I am now.
Okay, thanks for this overview. Let's get right into details. First thing I want to talk about these side letters. First of all, can you please explain what is a side letter or side letters and how they impact limited partnerships in the world of investments and in the world of funds?
Yeah, for sure. So I'll kind of set the table first so people know exactly what a side letter is. So basically, in most investment funds, or all investment funds, you have a general partner who is the party that runs the show. That's the manager of the fund. And then you have a bunch of limited partners, which are passive investors. So that's like the key relationship: general partner, limited partners. There's a document it's typically called the Limited Partnership Agreement. You might also hear it referred to as an operating agreement or an LLC agreement. It depends on the context, but there's this agreement, the fund agreement, and that outlines the relationship between the general partner and the limited partners. So it'll talk about economics, like what's the profit split? Are there any fees? Can people get out of the fund? All sorts of stuff like that. Sometimes in the fund formation process, you'll have a potential investor and they'll say, I'm interested in your fund, but I don't like X, Y, and Z. The fees are too high, or I want more of the profits or something. And you think, well, I want this investor, maybe they're a big investor, but I don't want to change the terms for everybody else. I don't want to just like change the deal from 80-20 to 85-15, for example, on the carry. You don't want to do that. But you really want this investor. So what you can do is you can draft what's called a side letter. And a side letter is a special deal that's just between the fund and one particular investor to give them special terms. So that's what a side letter is. And some common terms that you might have in a side letter, I kind of touched on a couple. You might give reduced fees. So you might say 2% is the normal management fee, but for you, we'll do 1.5 or 1% or none. It's kind of up to the deal. Similarly, you could decrease the amount of profits that the GP gets, so give the LP more profits. You could give LPs more information rights. You could give them the right to co-invest alongside the fund. Another common one is some LPs in a fund. So remember, like in a fund, you have multiple assets. So the LPs don't know exactly what the fund is going to buy yet in advance. So oftentimes LPs will have a list of stuff called excluded investments. And it's a list of stuff that LPs don't want to buy. And so this totally depends on each specific LP. But common things that LPs don't want to buy are like guns, drugs, porn, sometimes investments outside the United States, sometimes cryptocurrency, sometimes oil and gas. There's all sorts of stuff. It depends on the LP. So the general partner might say, okay, like we might still make one of these investments, but if we do, you're not going to be included. You're not going to participate in that investment. So yeah, I'll stop that little side letter rant and let me know if you have any questions.
Yeah, will the other limited partners will they know about it? A bit different contract signed with between GP and one of the LPs.
Yeah, so that's a good question. In the past, historically, they would not know as the default rule. So generally, limited partners know that side letters are a thing. And there's disclosure in the documents that say we can do side letters if we want to. But before, until very recently, there wasn't really any rule of showing LPs what are in side letters or really telling them about it at all. The SEC just passed a bunch of new rules. And these new rules say that you do have to disclose side letters, and the rules are kind of complicated. We don't have to get into the specifics, but as a general rule, you now do have to show side letters with material terms to other limited partners. Now, this only applies to certain types of funds. So a private equity fund would typically, I know your audience is largely private equity and similar things like that. For private equity funds, it typically would apply. So a private equity fund would have to show. For real estate funds, people are still kind of figuring it out as we kind of learn, how exactly the regulations apply. But it looks like real estate funds are not going to have to do this. So that's just the background law about disclosure. And there's another aspect which is really important, something I think GPs and LPs really need to understand, and it's something that GPs especially can screw up, is one side letter provision that's pretty common. It's called a most favored nations provision, and this was a thing even before the new SEC rules. But the most favored nations provision is like a really fancy, fantastic side letter term if you're a limited partner. And it says, if somebody else invests as much as me or less than me, so if I'm a $10 million LP, if someone invests up to $10 million and they have a side letter, I get to look at their side letter, and that side letter is now a menu. And I get to order whatever I want from that side letter. Like reduced fees, I want it. Like transfer rights, I want it. More information rights, I want it. And you could that LP could just take all they want. So that's obviously very, very good for the LP. But if GPs, and so that's, if you're an LP and you're making an investment of some size in a fund, you might as well ask, you might as well try, can I get an MFN? Probably they'll say no, but you can always, you miss 100% of the shots you don't take. From the GP side, you have to be really careful, because you don't want to accidentally give really nice terms to small investors, because maybe later you might have a big LP that wants an MFN. So when you're just starting to fundraise, you might have, you may have only raised $1 million, and someone comes in like, I want to write you $1 million check. You're like, oh my goodness, I want this $1 million check. And so you'll say, okay, we'll go from 20% carried interest to 10% carried interest for you, and you're so excited. But then later, someone wants to come in for $10 million, and they said, I'll only come in with an MFN. So now you're like, well, whoops, because now you're going to have to give them. I mean, you could negotiate with that bigger LP. You could say, okay, you get an MFN, but it doesn't apply to the 10% carried interest. I mean, you could try that, but that's not a bargaining position you want to be in. So I guess the moral here is just be careful what sort of terms you're giving to smaller investors, because you might want to give a large LP later might require an MFN. So you kind of want to be thinking ahead when thinking about side letters in this way.
How much do you actually see this being used, and how many those side letters per fund or per general partner, limited partnership have you seen per one fund?
Yeah. So it really depends on the nature of the limited partners. So if you're going to raise, like, let's say a $10 million fund or a $5 million fund, which at least like for what I do is pretty small, you're probably just raising from a bunch of individuals. And so often there's no side letters. Often there's no negotiation at all. It's just like, here's the fund. Do you want to join? And people say yes or no. And that's kind of the end of the story. On the other hand, we recently raised $200 or $300 million private equity fund, and that had 5-10 side letters, and some of these side letters get really obnoxious. Like one of these side letters was like 40 pages long, so it can get a little bit out of control. And one thing for GPs to think about in advance is often side letters can get expensive to negotiate. Now, it's often like kind of a good problem to have in a way, just because if someone's writing a side letter, they're not getting a side letter for $100,000 check. It's usually a very large check. So, it's kind of a good problem to have, but it is kind of, the less predictable, more involved section of raising a fund is the negotiation with big LPs.
Let's say LP comes in and says, I'm gonna invest like a $5 million dollar ticket, but I would like to have this side letter. There has to be like X, Y, and Z. Who pays for this?
That's a very good question. So typically how this works is just kind of zooming out a little bit. There's a big category of things in investment funds called fund expenses. And fund expenses are expenses that the fund pays. The fund pays means that limited partners are paying for it, because limited partners are putting in all the money. I mean, the GP might put money in and should typically put some money in too, but it's basically the LPs and then the GP's capital contribution constitutes the fund's capital, and that's what pays the expenses. So things that are fund expenses. So you'll have like paying attorneys, paying auditors, diligence costs, accounting, all this sort of stuff. These are fund expenses. There's typically a portion of the fund expenses which are classified as organizational expenses. And that's the cost to set up the fund. And typically, side letters are included in organizational expenses. So it's something that the fund in general pays for. Now, one quick complication wrinkle thing is there's typically a cap on organizational expenses. So usually how it'll work is the fund will say, the fund will pay all these expenses, and the fund will also pay organizational expenses, but only up to a certain amount. Say the fund will only pay $200,000 worth of organizational expenses. And if you go over that amount, the fund will still pay for it, but it will reduce the GP's management fee going forward. So it's kind of a complicated maneuver. The idea is, the fund is going to pay for it, but the GP is going to kind of reimburse the fund for it later. So it can get so if you have a big LP and they have a complicated side letter and it costs a lot of legal dollars, those costs kind of get socialized and paid by the entire LP base.
Again, based on your experience, when it comes to those big LPs, will they usually come in with their own side letters prepared, or they tell a GP that, okay, this is what I would like to have there?
Usually big LPs, the professional LPs anyways, they just have a list of stuff. Mm-hmm. And they'll just give us, here's our side letter, they'll say like our standard side letter requirements. They say it in some way that makes it sound like you really have to do everything they want. And then the next move is we, as the fund, we represent LPs too. So when we have big LPs, we're the ones who are sending this letter. But then the GP council looks at their letter and basically marks it up and says, no, yes, no, yes, no. As a practice point, like if you're a GP trying to raise a fund, what you often want to do is, like a lot of LPs will ask for similar things. like for example, the right to transfer to an affiliate or something like that. And so if you're a GP, what you want to do, or what you want your lawyers to do, is to try to standardize your side letters as much as possible. And so what I mean is, like, if one LP comes in and they want, provision 1, 2, and 3, then if another LP comes in and also asks for some version of 1, 2, and 3, then you basically give the second LP the first LP's version. So you basically, like, if someone wants to be able to transfer to affiliates, you just, create one transfer to affiliates provision, and anyone who wants it gets that. So that way it's kind of easier from the GP side to administer things. So it's just a simpler process.
What about some of the red flags? Or, we have a lot of listeners here, entrepreneurs, business builders, business buyers, investors. What is something myself and probably themselves, they don't know what you know already based on your experience about side letters? Something that is a common sense for you, but for me, it's like, I don't even know that this thing exists. Is there anything like this?
Yeah, to me, that most favored nations, the MFN provision, is really the big one, especially if you're on the investment manager side. Like, you don't want to screw up and accidentally give somebody really favorable terms, and then have to give those terms to everybody else. On the LP side, on the investor side, the passive investor side, I don't know that there's really a red flag or a way to seriously screw up, other than just not knowing that side letters exist. And honestly, it totally depends on how much your check size is. So if you're an investor and you're going to invest like an amount that's like 1% of the fund, you're not going to get a side letter. Like, it's just, it's not going to happen. But if you are contributing some decent portion of the capital, I don't know exactly what that threshold might be for a given fund, 5%, 10%, 20%, then you might as well ask. There's no harm in just saying, are you open to side letters? Can I get, maybe you want information rights. Information rights is common because a lot of LPs, especially like strategic LPs, part of the reason why they're investing, it's not just like for a return. Like, obviously the return on investment is important, but a lot of times LPs like want information. Like, they want to know how it works. We especially, this is actually especially true in my experience in venture capital, where big companies, like a pharma company, might invest in like a biotech VC fund. And it's not just because they want money, it's because they want to see what's going on. So you could also leverage that as an LP. If there's, a fund that's in an industry you're interested in, you could say, I'm going to give you like $200,000 or $1 million or whatever, but like, let me know what's going on. Like, have a quarterly meeting with me, explaining to me what you're seeing. So that's something you could try for. Again, it totally depends on your check size as to whether the GP will kind of entertain that.
That's very interesting. This is maybe something to use when talking with LPs, seeing that they're not interested in maybe the returns and all that, but they would know how it works for US investors investing in Estonia, for example.
Yeah.
That's a good point.
Yeah. People are interested in information. Information is important. So if you are, someone who's looking for investors, you can always kind of, like, pull back the curtain and be like, this is how things are going, as kind of an incentive to get investors in the door.
Because the guy, Mr. Family Office guy, I think is handled on Twitter. He said that what family offices do oftentimes is when there is a new fund or new opportunity coming, the first investment will be only like $25,000 to $50,000 for them, just to see, just to get the information, how professional they are, how good they are, how is all the communication and all that. And in the future, when the fund or the business raise additional capital, then if they like what they saw, it's going to be $1 million, 5 million, 10 million ticket. But the first one is just 25,000, even though it's a lot of money. But for them, they just want to see how it's going.
Yeah, no, totally. It's very common, actually. We just, like, we raised a fund this year where even a bigger institution invested, I can't remember the exact amount, it was $2 or $3 million. And then after a year, they added like 3 times as much. So now it's $9 million. So this is something that happens. It's very common, actually, kind of a test check to see whether they like what's going on, and if they do, then they'll invest more.
Okay, Michael, let's talk now about waterfalls. They can be complex. Could you break down the concept and its significance in fund structures, and start with maybe explaining what is a waterfall in a business?
Yeah, for sure. So a waterfall, at its basic level, is just if there's money to distribute, where does it go? So it's the share of the profits. In most investment funds, GPs, the people running the show, get paid in two main ways, and sometimes more, sometimes less, but usually two ways. First is like a recurring fee, a management fee, which is, for example, 2% of committed capital every year, and that's kind of a guaranteed sort of payment. And then there's this waterfall that we're talking about, which is where do the profits go? So there's a couple ways to talk about this. In the simplest way, for, let's say, a private equity fund, you could say, like, I'll give you a sample waterfall. First is the LPs get all their money back. So if LPs put in $100 and let's pretend you have $200 to distribute. LPs put in $100. Step one, LPs get their $100 back. And then step two, profits are split 80%, 20%. 80% going to limited partners and 20% going to the GP. So there was $200. The LPs got $100 back to return their capital. We have $100 left. And so 80 would go to the LPs, 20 would go to the GPs. That's how it works typically in a venture capital fund. In a private equity fund and in real estate funds and certain other types of funds, it actually doesn't look like that. The more common way is there's an extra step in between the return of capital and the profit split. And it's called the preferred return, which is something I'm sure your listeners have heard about before. But how it works is you basically have some sort of hurdle rate that has to be cleared before the profit split kicks in. So, for example, we could do the same example. There's $200. The first $100 goes back to the LPs as a return of capital. Next, we have this preferred return step. So 8% is a pretty common preferred return. Let's pretend that this distribution is being made 1 year after the capital was called. So just to make the math easy, that's $8. So the first $100, again, goes back to the LPs. Then there's this second step, which is the LPs get a preferred return of 8%, which is $8. You have $92 left over, and then that would be split 80-20 between the LPs and the GP. Those are kind of the two most common ways you'll see waterfalls in funds. There's like 1.5 million different complicated ways that you can arrange this, and like I'm happy to go into that if you want to. But those are kind of the two most common ways. And again, like sometimes people will get really fancy and they'll say, like, it'll be, for example, return capital and then 80-20. And then after the LPs have received twice their money, that it's 70-30. And after they've received 3 times their capital, it's 50-50 or whatever. You can get really crazy with how you arrange waterfalls.
What have you seen? Not even what have been the most common, but what have been what has been working best? And I'm not talking about the first time LPs, but the guys who are doing a lot of investments. What do they prefer?
In my experience, investors don't want to see something they haven't seen before. It is a common theme. And obviously sometimes that's not the case, but a lot of times that's true. And one thing that I see often is GPs will think, I've come up with a new paradigm. Like, this is so much better. The other 2 and 20 is the model that I just described. It's kind of like a trope in the funds world, 2% management fee, 20% carried interest. And so GPs will think, I've reinvented the wheel. This is so much better. And then we say, okay, from my perspective, I kind of try to steer GPs to do something that at least resembles the normal way of doing it. But sometimes they don't want to, and they say, no, I'm going to do it this way. And then sometimes that works. I don't want to say that doesn't work. Sometimes it works. But oftentimes what happens is they'll go out and market the fund with their terms, and they'll come back and they'll say, You know what? Let's just do it more like the normal way, because LPs don't really know what I'm talking about. So I like the phrase that I often use is like, as a GP, as an investment manager, you don't want to like have your big differentiator be your fee structure. Like maybe it can help, but like you should be differentiating yourself based on how well you can execute and how well you can invest, and trying to come up with some fancy way of restructuring the fees. It might work. I don't want to say it won't work, but you might get some confusion from LPs. So that's what I would kind of always just go towards the standard. And I will say, there's, as an LP, I would always kind of anchor to this 2 and 20 model as something that is reasonable, because there are a lot of funds. You know, I review a lot of decks, just kind of in my free time, I guess. And I see the craziest stuff, like just outrageous stuff. I once saw a 7% management fee. I once saw the profits get split. Well, no, it's not even the profits. Distributions are split 50-50 between GP and the LPs before there was a return of capital to LPs, which like to me is just insane. But like there's all this crazy stuff. So if I were an LP, I would just like see how close is this to 2 and 20, and it should be pretty close. Otherwise, you have to think, and then you have to think, you know, is this a structure that's good? Is it bad? I don't know. 2 and 20 isn't broken, so I wouldn't try to veer too off course in that respect.
But why do people try those extreme examples which you just said? Why don't they go with a 220? Are they fishing on the market, seeing that maybe there are some LPs, they don't maybe know what the 220 means or something like that?
Yeah, I think there's two main groups of people who try to go off the 2 and 20 model. I think there's one group of people who actually think that they've come up with, and I don't say this in like a pejorative way, like, but they think that they've come up with a way that is better for LPs actually. So a common thing that I see is GPs will say, like, what is this 2% management fee about? I would rather just align incentives. Like, there's no guaranteed fee. Nothing's guaranteed. I only get paid when the LPs get paid. I'm like, that's a very like good thing to think. I think, you know, like who's going to argue with that? That makes a lot of sense. The problem comes into play when, you know, a lot of these funds are long duration bets. You know, you might, in a private equity like situation, you might hold a company for 3 years, 5 years, 7 years before selling. And so you might not see any money until then. So then the idea is, what's the GP going to use to eat for the first 5 years? So then, you know, GPs start to realize, well, actually, we need some guaranteed income, and they often come back to the normal model. I mean, like people will say, I can't remember the exact terms of like Warren Buffett's fund at the beginning, but if I remember correctly, and I might be wrong, but I'm pretty sure he did something where he did not take any guaranteed fees. And that can work if you don't need the fees to live, but a lot of people do need the fees to live, especially, you know, first-time managers. Like, they need the money. So they often come back to it. There's another group of people that just like want to prey on LPs. So that's certainly a category. There's no question about that. I don't think that's most GPs. It's, you know, I would say like, I would not raise a fund for a GP who's trying to do something like that personally. I mean, that's just so I haven't seen, none of my clients have like tried that, but like I've seen the decks of people who have tried it. So it's definitely out there. It's definitely out there.
I was listening a podcast from Chris Powers. He builds a real estate fund in US, and he was actually talking about not charging any fees, and he's not fan of this because what you just mentioned as well, like the GPs, they have to eat as well, and even more importantly, how do you hire new employees? For example, if you want to grow the fund to larger size, maybe having 50 employees, how are you going to do this? How are you going to hire these people? And the interesting thing he added was he oftentimes having this conversation and even argument I wouldn't say argument, but with people who say that you should do it without charging any fees, and he's not a fan of this because of what I just mentioned. You can't really hire people. Another thing he added, he was talking with one guy who's been in this business for decades, and this gentleman said that during his career he only had like excellent deals which he can count on his hand, and you never know when those deals are gonna come.
Yeah.
And when you don't charge any fees, you're really hoping that the first deal is gonna be your best deal, but in most cases it's probably not the case. So to go in conclusion, he said that it's not a good idea.
Yeah. No, I think Chris is right. And you make a good point, or he makes a good point about employees. Because employees are typically not in that group of fund expenses we talked about earlier, things that the fund pays for. Employees are typically paid out of the management fee, which, I mean, the fund pays the management fee too, but it's generally expected that anyone at the general partner management company side, any of their salaries, any offices, any computers, anything like that, that's all paid out of the management fee. So you're right. If you want to hire any team members and pay them in cash, then you need some cash to do so. I mean, it's also common, just kind of as an aside, to give employees a small amount of carried interest. Anywhere from 1% to 5% is pretty common in addition to a salary. But again, they're not going to see any actual money from that carried interest for a long time. It can be many, many, many years, especially because in the typical waterfall, the LPs have to get back all of their money from all of the investments made first. So that could take a really long time. You might have to sell 50%, 75% of your deals before that starts happening. That might not be for 7 or 8 years.
Now, I want to talk a little bit about investment fund structures. Are there any specific exemptions or regulations that entrepreneurs should be aware of when structuring their investments to avoid those legal pitfalls?
Yeah. So, I mean, as far as structure goes, we typically form Delaware entities, usually Delaware limited partnership for investment vehicles, and then either limited partnerships or LLCs for upper tier entities. And so that's like the general partner management company, things of that nature. If everyone's in the US, all Delaware works well. It gets a little bit more confusing once non-US people start getting into the mix. And this totally depends on the asset class and where the investors are. So the most common is in many funds, including like all types of funds, venture funds, real estate funds, private equity funds. The fund might create certain income that certain types of investors outside the US don't like. It's called ECI, effectively connected income. There's actually a similar concept called UBTI for investors who are US based, but who are tax exempt, like universities or foundations or pensions. So basically, you have to create fancy structures to make these investors happy. So, for example, like if you, as an Estonia resident, wanted to invest in a US real estate fund, for example, you might have to ask the fund managers, like, what are you doing about, people in Estonia? Because otherwise what might happen, and like, I'm not a tax lawyer. So, this is all, talk to your tax lawyer. But basically what happens is if you are also, none of this is legal advice. We forgot to say that. That's important. If you are outside the US, then if you're getting income from US real estate, for example, or certain types of income from private equity companies or whatever, you might then have to start filing tax returns in the United States, and then also have to pay certain extra taxes to the United States government. So that's no good. People usually don't want to do that. So then you have to do creative structures, which are probably like, it's too complicated to get into on the call. But essentially, you have to form entities taxed as corporations, and then have these non-US investors or tax exempt investors invest through those corporations. So that actually gets like very, very complicated for, as kind of like to bring it back down to a practical level. If you are a general partner who's thinking about accepting money from people outside the US or from tax exempt entities, just make sure you talk to a tax lawyer who knows what they're doing so that you can create a structure to accommodate those sorts of people. On the other hand, if you're an LP outside the US, for example, and you're going to start investing in US vehicles, you really want to like ask your tax person in your home country, maybe ask somebody in the US too, like, what do I have to do to not get in trouble here and have to pay some outrageous amount of taxes and start having to file US tax returns? So those are kind of the practical implications.
A question about like tools and technologies, because listening you, this is, let's be honest, this is not the stuff I'm reading on day-to-day basis about those structures and security laws and all those things. Do I even have to consider using any tools or technology or to automate the system, or how to put these papers together? Or at the end of the day, the best idea is to just reach out to people like you and leaving this to you?
There are some automated options out there right now already. Usually they're very simple. So they're only good, at least like in my opinion, they're only good if you have a very simple setup. Especially they're mostly in the venture capital space. So like AngelList, Sidecar, there used to be one called Assure that went belly up. But there are options where you can basically just plug in some information and get a special purpose vehicle just popped out the other side. Very low cost. They'll administer it too. But they're very inflexible. They definitely could not deal with at least at this point, from what I've seen, they can't deal with, complex tax structuring, for example. So for most people forming a fund, I would personally recommend working with a lawyer. Obviously, I'm biased because I'm a lawyer who does this, but that's my opinion. I haven't quit and found a new job, so I think this is a good business to be in that is valuable. I do think that, at least in my opinion, it's important that lawyers start using as many tools to automate their own processes as possible, so they can lower costs for clients. And just because, like just drafting documents over and over and over again is not like the most exciting part of my day. The most exciting part is talking to clients and teaching them how all this stuff works. So I do think that, if there are any lawyers or law firms or anything like that listening, I think like the move is towards automation right now. If you don't do it, you're going to look silly because you're going to be twice as expensive as the people who automate. So I think it's something that's coming and something that's really important.
When it comes to your job, which side do you see more, LPs or GPs?
I do probably 80% GPs. I do mostly GPs. I do LPs as well, but typically, only big LPs. Just because, if you're only going to invest 50K into a deal, for example, and you're an individual, you usually don't want to pay a lawyer. I mean, sometimes people do, but it's usually like big institutions, like people writing this $20 million checks, things of that nature. So mostly I do the GP side, but I do both.
Okay. So I want to talk a little bit about the relationships, and my goal personally is to be more towards this GP side for the next, hopefully 5, 10, 20 years. But what are some best practices for building and maintaining those strong relationships between GPs and LPs? And now, again, focus should be as a GP of what should I be doing?
So the two best things I would say, one is treat it like a serious business from day one. So, hire professionals to help you. Again, I'm biased here, but like there are some people who just like try to do the documents themselves and do all the accounting themselves. And in my opinion, that's not a good idea, because a lot of what I do, maybe 10%, 20%, is cleanup from people who didn't know what they were doing and now have found themselves in a big mess. And I mean, I've seen some crazy stuff, like stuff that is just totally bizarre. So like there's people like one GP who just forgot to put the waterfall in the agreement. So Like they just didn't get, like they weren't entitled to carried interest. Like they just forgot the waterfall. Like I don't know. It's just like totally bizarre. Um, Stuff like that. Just things where like clearly they didn't have a funds lawyer involved, and they just like they blew it basically. So and same thing with accounting. It's not just lawyers. If you're trying to do your own accounting, like your own tax returns, all this other stuff, you're probably going to screw up. You might not screw up, and that's it's certainly possible you can do it okay, but I would try to set everything up properly. There's also a lot of rules, regulations that you might blow if you don't set it up properly, and then you might be subject to like all these laws that you didn't think you're going to be subject to, and like it can get to be a bit of a mess. So that's one part, and then the other part is just communication. And it's kind of bizarre to me, like how bad some GPs are at communication. I mean, many are very good, but like, you'll hear stories of people who are like, I didn't hear from the GP for like a year, and then they asked for more money or something like that. Like that's no way to do it. Also, sometimes people will just change their investment strategy all of a sudden without telling the LPs or telling the LPs much later. That's no good. I mean, that's like arguably securities fraud, because like you have all these documents saying, like, for example, like we're going to invest in HVAC businesses or something, and then like instead you go and buy some apartment buildings. Like that's not what you said you were going to do. So like theoretically that's like securities fraud because you lied about what you were going to do. There's many things that in most LPAs, the GP will be able to do a bunch of stuff on their own, because they're the boss. That's kind of how it's structured. It's not a bad idea to ask LPs for permission for things that you're kind of on the fence about. So one thing that's relatively common in various types of funds, including real estate, private equity, both, is transactions with affiliated parties. So like the management company or the GP might like provide services to the fund, or they might provide services to portfolio companies, or they might sell something from themselves to the fund, or there's a whole bunch of things like that. I would always get the LPs, like tell the LPs, first of all, that this is going on and try to get their approval. It might be annoying to get LP approval for various things, but it's a lot better than LPs losing money like 5 years from now and then being upset with you and suing you and saying, you didn't tell me about this and now I'm mad. So I think communication is really key, because sometimes, it's not always going to go well. Sometimes you might not make as much money as you thought. Sometimes you might lose money. But LPs are a lot more understanding if you're giving them quarterly updates and being transparent than if you're just like, in the dark. And along the same lines, another crazy thing I saw recently is just like being truthful about valuations. And this is probably the most, I don't know if it's the most important, but it has at least become very, I don't know, it's become kind of a big thing on Twitter recently in VC, in venture capital, because like people have the same companies. Like these shares are fungible. Like you'll have shares of like company X, and like this woman Stevie on Twitter like shared this chart, which was so crazy, where it's like company X, and then like this fund is valuing them at like 30% above their last round. This other fund is valuing it 10% above the last round. This other fund is valuing it like 80% below the last round. And it's just, there's no consistency. It's totally crazy. So I don't know. I would just say like communicate, try to be transparent, don't make stuff up, and be reasonable.
How much dodgy stuff you actually see? I mean, you see stuff every single day, you hear news. How much dodgy stuff you actually see?
I mean, a lot. I mean, I luckily, like in my actual, like a lot of people come to me to raise their first fund or raise their second fund or raise their third fund, or, sometimes raise their ninth fund. And usually these people who are like coming to like a law firm like this are usually pretty buttoned up. So
Mm-hmm.
in my actual job, I don't see that much crazy stuff. I mean, like I said, I do have a decent contingency of clients where they just used like a normal corporate lawyer to try to raise their fund one, their first fund, and it was just like a train wreck of documents. Usually that's not like, that was just kind of a lack of education, not trying to like defraud anybody or something like that. But for things like through other people and just reviewing decks and things of that nature, I do see a lot of crazy stuff. Just lying and just crazy terms, crazy terms that don't make any sense.
You mentioned the communication, and I was listening. Harry Stebbings, he runs the 20 VC fund, and he said he made like 39 investments, and only 7 gave him reports, and he was
Wait,
surprised.
what? Wait. He invested in that many. Was it a fund of funds, or he invested in that many companies?
Companies.
Okay.
Yeah.
Okay. No. I think that's what you said. I just wasn't sure. Okay.
Yeah,
Yeah.
yeah, and only 7 were giving reports, but those 7 were doing really, really well as well. But my question is, what were the other like 32 were doing? Even though things are not going that well, like you are not giving reports, and you just mentioned communication is extremely important. My question is like, how on earth is this even possible? Because Harry Stebbings, he knows stuff, he makes good investments, but still, are those people too busy? Do they don't know the basics? Interesting.
Yeah, I mean it's hard to say. I mean I would say, if you are a company who's trying to find investors, you're not going to be as likely to get them to invest in the next round if you're not going to give them any financial information. That's for sure. That's honestly, that's a crazy statistic. That's beyond anything I would have expected, that so many companies weren't provided reporting. Like no communication at all, or they just weren't doing their quarterly or like financial statements. Do you know? I mean, in any case, it's kind of bizarre.
Yeah, he just mentioned that these were the numbers. 7
Yeah.
out of 39 gave him some sort of reports. Maybe the ones maybe gave some overview once a half a year or something. But I don't know the exact details. But this is
Yeah.
something they were discussing.
Yeah, that's crazy because I'm sure they had like, I'm sure that the fund has like information rights at the portfolio company level. I'm sure there's a contractual duty for the companies to send these reports to the fund, so they're probably like in breach of contract too. But yeah, that's nuts. Don't do that. But that's just kind of a lesson for any business. Don't keep your investors in the dark.
When it comes to putting together, forming a fund, uh, what are step by step the steps? Someone listening, they want to put together a PE firm, start
Yeah.
acquiring HVAC companies. Don't maybe go into too details of what each document or contract should include, but going step by step, what should they do?
So as far as the steps, like we'll just go super high level. One is decide what the terms of the fund are. You'll do that with your lawyer. Next is take those terms out to the market and see what people think. So it's kind of just like a test, basically. After investors, and you'll take the terms, and you'll take a deck out to go market. And once you have enough interest, typically your law firm will prepare all of the documents and form the entities for you. So they'll form the fund, they'll form the GP, they'll draft the LPA. If there's a PPM, they'll do that. They'll draft subscription documents. And then you give all those documents to the investors. The investors will look at those documents and they will either sign them, they'll say, okay, good, we're in, or they'll complain and negotiate. And that's when we might get into the side letters that we discussed earlier. You can also just decide to change the LPA too, if you want to change the deal for everybody. But so then investors are signing documents or negotiating and then signing. Then basically, all at once, you sign all the documents. The GP signs all the documents, and then they file some stuff with the SEC and some other similar things in the U.S. states if they're a U.S. fund. And then at that point, the fund is formed. It's kind of done, and the GP has the right to call capital from LPs. And then typically the GP will call capital and make investments over a period of 3 to 5 years. And then typically the fund will wind down after 10 to 12 years, something of that nature. So that's the high level view.
Perfect. One question. I don't have
Yeah.
experience. That's why I'm asking. You mentioned
Yeah.
the LPs invest the money over the 3 to 5 years. What if on year 3 you're not doing that well, and one of the LPs says that, okay, enough is enough. I'm not interested in investing more capital. What happens then?
Yeah, no, that's a good question. So as a general rule, the LP can't do that. As a general rule, you sign up for $100, you're giving the GP $100. That's the general rule. Now there are a couple of other ways that LPs can deal with this. So in many agreements, the LPs will have the right to either remove the general partner or shut down the fund. Now, so there's two options there: remove the general partner, shut down the fund, and then there's also two ways that can happen. One is typically a lot of the LPs have to vote to do one of these things. So like 85% of LPs or something like that have to say, you know what, we're done. We don't like this. You're doing a terrible job. We're shutting down the fund. And so they can do that. Another way is typically a majority of LPs, a much lower bar, can shut down the fund or remove the GP if the GP does something really bad. And so really bad, it's usually called a cause event. That's like the typical legal term. And that is like the GP committing fraud or acting with gross negligence or getting bankrupt or something of that nature. So the LPs can pull the plug. This is not in all fund agreements. I mean, if you're an LP, like you can always like try to see if this is an option. Totally depends on the fund, but it is something. It is like a lever LPs can pull in many instances. You're not going to see this in most like $5 million, $10 million funds, but in bigger funds you will.
I was listening to a podcast yesterday with Anthony Pompliano was interviewing Graham Weaver from Alpine Investors, and Graham said that the first fund he started, he really messed up. I think all of his, I don't even know how many investments he was losing money, and it was very, very bad. How often do you see people like this who really mess up big time, losing investors' money, losing LPs' money? How often do you see them recover, coming back, building another fund, doing much better?
I mean, it kind of depends on the person. I mean, it's certainly possible. It's certainly possible. It often depends on where in your career you are. Just because, like, for example, like most people who raise their first fund are passing the hat around family and friends and people where they've cultivated a good reputation over the course of their life. If you just lose all their money, that's kind of like that was your shot, So if you have some way of finding investors that's not your friends and family, maybe you can recover better. I mean, we've definitely helped people raise funds that have subsequently crashed and burned. Probably the most like the biggest example was somebody who, I don't know if you like follow crypto stuff at all, but like they invested all of their money in Terra Luna. So their fund just went to zero. So I don't think they're raising another fund. But it's certainly, it kind of depends on how much access to capital you generally have. I think a lot of people, if you screw up the first time, you're done. And that also like kind of leads to a statistic you often see floating around that like first time fund managers actually provide better returns than more established funds. And I think a big reason for that is like first time fund managers are terrified, like they need to make this work. They'll like waive management fees. They'll keep costs down. They'll work all day. They'll do whatever they need to do to make the thing work. Because if it doesn't work, there's not going to be a fund two. Whereas like if you're on Blackstone Fund 147, like it's Blackstone, if one Blackstone fund goes down, like Schwartzman's going to be okay, So I think that's part of the reason.
Have you seen any changes in a recent regulatory and I mean something entrepreneurs should be aware of when it comes to structuring their investment funds? Has there been any changes?
Yeah, I mean, so we kind of talked a little bit earlier about the changes to the side letter rules. They're basically the SEC just changed a bunch of the rules that apply to private funds, which a private equity fund would typically, like a smaller private equity fund would typically be one of these private funds. Um, there's too many rules and they're too complicated to get into specifically here without boring everybody to death. But if you do want to, I'll just give a high level overview. There's new requirements for auditing certain types of funds. There's these new side letter rules, like I described. There's certain types of expenses that you cannot charge to the fund without specifically disclosing them anymore. If you want to look it up, it's basically if you type in like to Google or whatever, SEC private fund rules, like all the news and everything will come up and you can kind of look at the specifics. I mentioned this a little bit earlier. It's not clear that these apply to real estate funds. I think at this point, the consensus is that they only apply to VC, private equity, and hedge.
What you see, what people like myself and others who build funds, build businesses, make investments, what are some other than the documents itself, what are some resources and documents they should be reading in order to understand and maybe educate themselves on those topics?
I think Twitter's pretty good. There's a lot. It kind of depends on your industry. I mean, I've kind of been more on the real estate side myself, like as far as like my own investments. So there's some good books in that space. In particular, there's one called The Hands-Off Investor, which is very good in my opinion. And that actually, even some stuff in that book would apply to other types of funds as well. I have a YouTube channel if you want to check that out, where I post a lot of content about this. Other than that, I mean, I often find that the best way of going about this is just talking to other people who have done what you want to do and ask them. Because a lot of this stuff will depend on the specifics of what you're up to. Like, for example, like if you're interested in like search funds or like ETA and stuff like that, Stanford has a lot of documents which are helpful if you want to get into that space. Really depends on the specific asset class that you're into. From my end, like funds are similar. I can do VC, PE, real estate. It's all like, to me, it's like the DNA is like 80% the same across all those. But if you're the actual operator, then there's not really much similarity between like early stage venture and office properties. So I think the best move is to talk to operators in your sector and ask them, what resources they think are the most helpful.
Was there something I didn't ask, which you think people listening, again, people building businesses, buying businesses, raising capital, building funds, something they should know about which I didn't ask?
I guess two quick things. One is just that maybe this ties to your legal regulatory question from before. Maybe I should have touched on it there, but this isn't super new. But about 10 years ago, the rules changed such that now you can market publicly. So on Twitter, on LinkedIn, on podcasts, using something called 506C. And to do that, you have to verify that all of your investors are accredited, which if they're an individual means they make a certain amount of money or have a certain net worth. There's rules for entities too, but that could be a good option for people who are raising their first fund. They can tap into these public sources, especially if they have large followings. So that's something I would consider potentially if I were raising capital. It's not just for funds; it's really for any securities that you're selling. So this would apply if you're raising money for, just like an independent sponsor deal or a startup or anything of that nature. It would apply to that. The only other thing is just a lot of times people raising money get very excited and they get very optimistic and they say a lot of things. And I would just, this, again, I'm a lawyer, so like maybe this is just me wearing my lawyer hat, but I would try to like be conservative when you're running your models. Like, don't get too crazy. Don't like take the like bull case scenario and make that the base case scenario. Like, try to be even keeled. Investors will appreciate that. Like, if you say like, oh, we're like underwriting a 37% IRR, like investors are just going to look at that and they're going to say, this is a goofball. They don't know what they're doing. Like, I don't believe that. And 10 years from now, if things don't go super well and in your marketing materials, you were reasonable and even keeled, that's going to look a lot better than if you said, we're going to make like 100% IRR. Like, and the thing is, like, I only say this because I see stuff on social media all the time where the projections are insane. Like, people have been throwing them around Twitter. It's like, oh, like guaranteed 16%. Like, there's no such thing as a guaranteed 16%. That's not a thing. Or like projecting like 27% IRR for short-term rentals or something. It's just nuts. So I was like, keep it conservative. It might not be as fun as like putting out crazy projections, being optimistic right now, but in the long run, you'll be grateful you were conservative.
Few extra questions about what you mentioned, because I totally forgot to ask. You mentioned promoting on Twitter. I mean, what you can say and what you can say.
Yeah. So it's a good question. There's kind of like, can you say anything or can you not say anything? So that's kind of this 506C thing. So if you're 506C, you can speak publicly about fundraising. If you're not, then you can say stuff like, oh, like, I'm Michael, I like venture capital, stuff like that. Or you could say like, I think these companies are good or stuff like that, but you can't say anything about fundraising. You can't say like, oh, I'm raising a fund or stuff like that. Nothing about that. If you're 506C, you can talk about that. It's a blurry line if you're not 506C. It's kind of hard. There's no like list that the SEC puts out that's like, this is what you can say and this is what you can't say. It's just generally like, don't sound like you're fundraising. So that's one component. The other component is you can't say something that's going to be misleading. So this kind of gets to, these crazy projections that I was just talking about. Like, you can't say there's going to be a guaranteed 16%. Like, there's no such thing. Like, that's not a thing that exists, certainly not in like real estate and private equity and venture. Like, maybe what they mean is there's a 16% pref hurdle or something, but that's far from guaranteed. Like, you could lose all this money and then you're just inviting investors who lose their money to say, they guaranteed me 16% and then sue them for securities fraud. So that's kind of the background. I will say, like, a lot of people on Twitter are just like not paying attention to any laws at all, which I don't think is a good idea personally, because often like investors aren't going to complain when they're making money. Like, they're not going to think about like, oh, did the GP follow securities laws? Like, they don't care. But I think with what's been happening over the last couple of years, a lot of people have started losing money. That's when they start lawyering up and they're like, well, let's see if we can get this GP for something. And then it turns out they've just been blasting their deals on Twitter inappropriately. And if that's the case, then maybe the LPs can get their money back. And that's not going to be fun for the GPs.
I'm asking because I think Twitter, my audience, I can be wrong. I think 70% are from USA. And I've been sharing openly what I'm doing and what I'm trying to do. I can say by 100%, I haven't promised any returns.
Yeah.
Only ones have been the securities for a consumer loan business where we raise bonds, raise securities 12 to 14%. Depends of the amount, depends of the period. Yeah. But I haven't really promoted that in a way. But what I've said is, I'm doing cold calls to investors. This is the terms this is the opportunity I'm selling. This is what we do. But I haven't been really promoting on, hey, attention. This is what I do. Here you can sign up. And so my question is, not even a question, but just story to myself that I hope I haven't done anything wrong.
Is this the free legal advice section of the podcast? Yeah. So I think it honestly depends like where you're going to close on investors from. If you're like going to raise money from U.S. people and U.S. people are going to be giving you money, then you might want to think about like whether you're like specifically following the U.S.'s laws. If you're not actually raising money from anyone in the U.S., then it doesn't really apply as much, because then it's like if you're just raising money from people in Europe and there's nobody in the U.S., then like what does the U.S. have to say about that? You know what I mean? Like you're not in the U.S., the investors aren't in the U.S., the business isn't in the U.S., so you might be able to be outside the U.S. laws in that.
Okay, Michael, it's been good fun. Let's wrap up with a famous five. How old are you?
I am 32.
Favorite book?
One that I'm reading now, which is pretty good, is a documentary by Robert Caro of Lyndon Johnson. It's pretty good.
Married, single, kids?
Married, one baby.
What car do you drive?
A Subaru Crosstrek.
What's the best investment advice you've ever got?
Study history. I think a lot of people kind of get a little bit too narrow-minded and only look at the past few years, when if you go back and look at the past, several hundred years, you have a much different perspective on what's going on now.
You mentioned YouTube, but where can people find you?
Yeah, so Twitter's good. It's investing_law. YouTube is good. It's The Investments Lawyer. And then LinkedIn is just my name, Michael Bjorn Huseby. Yeah, that'll do it.
Perfect. Again, thanks a lot, Michael, for doing this. I just sent you a message. You said you're happy to do that. Thanks. Big thank you.
Yeah, absolutely. Really enjoyed it, man.